Also talk about the implications of this second wave that is tormenting India. William Foster, Moody's Investor Services, now joins in on the show. William, good to have you on board. Now, to begin with, your latest report seems to suggest that this second wave of the COVID poses a credit negative risk to economic recovery. Could you quantify how much of an impact this could potentially have on economic growth?
Well, I can't quantify it right now. We're going to be basically monitoring the lockdowns at this stage and the spread of the virus to get a better sense as to how to quantify it and to ultimately revise our GDP forecast accordingly. But we're at the very early stages of this, obviously, and what we're seeing was, obviously concentration of the spread of the virus in Maharashtra, which is an important economic center, but now seeing it more broadly in other states, and it's happening very quickly. So to try to capture that, the economic impact at this moment is very difficult because there are many different scenarios that could play out. But it's clear at this stage that the impact will be more negative than the forecast we currently have, which we're expecting an acceleration and not anticipating a second wave, as we had been forecasting about 13.7% real GDP growth for this fiscal year. And obviously there's significant downside risk to that at this stage.
And add to the mix rising inflation as well, William. How much of an impact is this going to have in terms of pressurizing growth across the globe, that is?
I think the extent to which that could be a headwind to growth really is if the RBI were to respond with less accommodative monetary policy at a time when you have growth pressures because of the conundrum of higher inflation. But at this stage, I think it's, again, if you do have enough pressures on growth and in terms of headwinds to the recovery because of the virus, I would imagine the RBI is going to take that into obviously consideration and try to weigh the cost benefit of higher inflation. But it does make it a more difficult decision from a policy perspective when you have these inflationary pressures that may be building on top of the emergence of the second wave.
Sure. William, as long as the Fed and central banks maintain the easy policy, do you think India will be a gainer in terms of fund flows?
Well, certainly, we expect the Federal Reserve to maintain interest rates around where they are today and for at least the next 2 years. And that's what they're continuing to forecast. We believe that will be the case. We believe there will be a jump in inflation based on just pent-up demand being released. But we think that overall rates will remain low. To what extent that can benefit other countries really, I think, will in large part also depend on just the overall outlook for growth in those countries and recovery from the shock from COVID. The U.S. is experiencing right now, and is the beginning of what we expect to be a very strong recovery and growth. But if we're seeing second waves around the world, I believe that what we're going to need to see most likely is a emergence from that and clarity that this is going to be with vaccine rollouts and ultimately with public health responses that are effective. That will then, I think, pave the way for stronger growth and benefits from lower interest rates. But the public health response is really critical at this stage to prevent the widespread of the virus in the second wave.
Sure. India was expected to grow faster in FY22, but now with the second wave, how do you think that is going to change, and what is the risk on the fiscal deficit that we run?
Well, with regards to the deficit, we think that the budget laid out what we think is a relatively transparent and achievable deficit, provided growth does pick up the way that we had anticipated. I think the government in the budget was expecting nominal GDP growth around 14.4% or so. That translates to real GDP growth probably around 10 or 11% or so, and that's what the government has been forecasting. We think that's achievable, but this risk of the second wave really creates potential scenario in which that will be more difficult to achieve the deficit reduction that they had been pointing to, mainly because that would result in a situation where expenditure might have to be diverted away from capital CapEx, as it had been intended to in the budget, toward more of a public health response. With lower growth, you'd have lower revenue generation, and that would put some pressure on the budgetary outcomes. But I think it's definitely too early at this stage to start forecasting any changes on that front, because we really just don't know to what extent this second wave will play out as the duration of it and how acute it will be. Hopefully it will not be. And if that's the case, I think we'd be maintaining our forecasts that are in line with what the government had been indicating in February in terms of deficits.
Right. William, finally, could we expect some sort of a lesser impact or some sort of a cushion to the economy this time, given the fact that there is a focus on micro containment zones to deal with the curfew and the infections which are rising?
Well, if you look at other countries around the world where you have a lot of work at home that's going on, it's certainly been very helpful that this is a trend that had already started obviously before COVID, and it's been a very, very helpful for the businesses that can do that. But, I think what we have to remember is that there are many other businesses where that's not the case. Certainly when you have more informal economies like you have in India, when you have a high concentration of jobs in the services sector that, are not geared toward this, where people consume actual need to leave their homes to consume these goods, like restaurants or going to get your haircut, things like that. And so, to the extent which there's a concentration of jobs and livelihoods in that sector, which certainly is the case in India, it's going to be harder for the overall economy to perform as well as it could have if you have to continue to rely on at-home jobs, because that's just not the structure of the economy is, in terms of overall livelihoods, is not supported by those jobs, even though they are high productivity and contribute to growth. So I think we need to keep that in mind.
All right, William, we'll let you go on that note. Appreciate your time. Thanks very much for joining in.